Well, thank you very much, Sean. I mean, I came here initially in 1979 to read pure mathematics, and then within a year I'd switched into mathematics and economics. Lots of happy memories here. I remember dropping a term paper from Marcus Miller sitting there on the road. I used to cycle from Leamington, we lived in Leamington, cycle in every day with my work, dropped a term paper in the rain, just as I was coming into the university. It's a pleasure to be here. In terms of what we do, I should describe, Jefferies International is an investment bank, but we trade all these government bond markets. We're very focused on the flow. We see an awful lot of the investors. I travel extensively, meeting investors, central banks, and so forth. And we knew that this crisis for the Eurozone would be very difficult to resolve. Effectively, it's not an optimal currency area, we know this. Fiscal union didn't occur first, unlike other situations. They've created a monetary union without a political union. And the markets, being markets, understand the flaws in the system. Now, talking to Marcus a moment ago, obviously we're in a situation of still a bad equilibrium. Mario Draghi has taken out the tail risk of EMU breaking apart. So, going back to, for example, to Asia a few months ago, investors there were actually buying Eurozone assets again. But this was a complete change from about 18 months before, when they stopped buying any Eurozone asset whatsoever. But they're now much more discerning. They understand the market dynamics a lot better. They understand the Eurozone crisis hasn't been resolved. They know that, for example, the Spanish market, the Spanish bond market, is highly liquid compared to that of Italy. So they're playing the spread. When Spanish yields go to a certain point relative to German bonds, which are seen as the safe asset of choice, they basically buy Spanish bonds, spreads come in, they then exit that trade. They're also aware that the Eurozone now has fallen into recession. Now, how can you have a system in a good equilibrium if the system as a whole is actually in recession? That is another issue here. And moreover, the communication style of the ECB is very different to, say, the Bank of England or the Federal Reserve. So you haven't as yet got the ECB really doing what the Bank of England has been doing here, or the Federal Reserve in the US, or the Bank of Japan in Tokyo. They're not actually, at the moment, doing quantitative easing. In fact, they still have not got their key policy rate, the refinancing rate, at the zero bound. Meanwhile, the system as a whole has been dragged into recession. Now, I'm going to run through a couple of charts which sort of highlight this. I have packs with hundreds of charts, and I don't tend to show them all. But I'll start with one that's highlighting that we are now in recession, which is an obvious point, really. This is a very simple chart, just shows the level of GDP since the start of the downturn. I've indexed it to 100. So I've got the Eurozone as a block. I've got Germany, France, Italy, Spain, the Netherlands, and also Portugal. And you can see that the level of GDP for the Eurozone is still significantly below where it was at the start of the downturn. But you can also see what happened to Portugal, and also what's been happening to countries like Spain. And in particular, you can see that as soon as Portugal went into a programme, effectively in May of 2011, their GDP started effectively falling off a cliff. The other thing that people are very aware of is the Netherlands. And I was in the Netherlands again last week, seeing investors. They're very concerned. Their economy now is quite clearly in recession. They had some pretty poor GDP figures for the third quarter of this year. They're currently a AAA sovereign. They have a AAA rating, as we in the UK have, as Germany, Finland, and Luxembourg also have. But they're going to lose that. The housing market there is correcting very severely, and the dynamics there look pretty poor. Obviously, the Netherlands, relatively small, open economy. We don't have a breakdown of those GDP figures yet, but a lot of it will be movements, I'm sure, in net exports. You can see Germany at the top. Germany has obviously been outperforming. Now, another chart just to highlight problems in Greece. We all know this. Greek GDP has collapsed. It's down almost 25% since the start of the downturn. I've also got here the US. So I'll touch on the US more in a moment, but that is the US. You can see, like Germany, US GDP today is above where it was at the start of the downturn, at the start of the financial crisis. The Eurozone is in a different space. But the amazing thing with Italy is just confidence just evaporated and GDP collapsed. It's just fallen off a cliff. Now, it's almost as if the economy is sort of shut down. Spain has actually carried on outperforming expectations, although Spain now is in recession quite clearly. Spain is a glide path doing this with the risks it does that. And then, as I described, you've got the Netherlands, which, highlight again, this is a AAA sovereign. It's now back in serious recession, and most of the clients I meet there, who are big investors in Dutch bonds, think that the Netherlands will lose its AAA, which again is just, it shouldn't be happening, really, it shouldn't be happening. Other things I can highlight: employment and tensions turning down, also the weakness of real household disposable incomes. The consumer in the Eurozone is 57% of Eurozone GDP, and this is the key determinant of Eurozone consumption. It's collapsing. Now, this is one of the issues again when we do financial history. We compare what we're seeing at the moment with what we saw, for example, in the 30s. So in the UK, in the 1930s, our GDP only fell 5% peak to trough. In the US, it fell by about 30%. What were the key differences? Well, in the US in the 1930s, the banking sector saw its balance sheet collapse by 30%. So you had the same contraction in the bank's balance sheet as we had in GDP in the US. In the UK, the money supply actually expanded because we had a building and construction boom. We also came off gold, of course, in 31, which was, again, exactly what you want to do going into a financial downturn. You want to get your currency devaluation out first. And the other thing that happened is that real wages actually started accelerating. Now, I'm going to be careful to say on this because we have deflation in the UK, but basically real wages accelerated. And if you arithmetically look at the boost to GDP in the UK in that period from the consumer, it was boosting UK GDP by over 2 percentage points a year. So the consumer was helping the UK in that period recover. Now, in the case of the UK at the moment, one of the key reasons we've really struggled to recover out of this financial crisis, why GDP has basically been going sideways for so long, is that real wages have been negative. You've got average earnings growth about 1.5. You've got inflation in the UK that went to a peak of 5.2. You've got really negative real wage growth, and that's been prolonged negative real wage growth. That's been a key factor holding back the recovery here in the UK. In the Eurozone, you've got this happening. Now, this may be as bad as it gets, but that tells me that we're going to have a period of ongoing weakness in Eurozone GDP over the next 2 quarters at least. And the problem for me is I spend a lot of time doing econometrics, and I realise I can't forecast anything. You get structural breaks all over the place. I'm told that although there's been huge advances in computer technology and econometric techniques since I was certainly studying the subject a long time ago, basically forecasting has not improved. So A, we know we're in recession. B, we don't know how bad the recession is going to be, and C, we don't know when the recession is probably going to end. But we are in recession. That's the bottom line here. Now, in my sort of pack, I've got some stylised GDP forecasts for the Eurozone. And again, I'm just going to find where I've got them in this thing. But what I've got here is a comparison with the US. Now, I do assume that we do actually get a recovery in the Eurozone basically from the 3rd quarter of next year onwards. It stops falling, GDP stops falling in Q2 of next year, and we get some recovery going forwards. And what I'm doing here is breaking this down for the larger countries. I've got the UK here in comparison, and I've also got the US. Now, the markets at the moment are really worried about a fiscal cliff in the US. Really worried that GDP in the US is going to collapse. Now, my colleagues in the US are actually envisaging that GDP in the 1st quarter of next year in the US does actually fall by 2.5% annualised, which works out about 0.6, 0.7 on quarter. So you can see that in the graph. And then you can see US GDP continues recovery. It's got almost escape velocity. The US is now re-entering almost a period where you can get sustained recovery going. In fact, it's been recovering now for 13 straight quarters. The housing market in the US, which is a key lead indicator, is also turning up very slightly. So all this is all encouraging. If it wasn't for that fiscal cliff, you could just see the US almost recovering, not in a straight line, it never works that way, but the US is escaping recession. And GDP, well, GDP just basically gets back to where it was at the start of the, well, it doesn't quite get there, actually. I've sort of got the chart. It doesn't quite get there. So it's all pretty poor. I've got the Eurozone on this, I apologise, but it's all very, very poor. So what do we know about the ECB's reaction function to this? Well, what we know is that in the running into the summer, there was a real risk of an EMU breakup scenario developing. Basically, the banking sector, and this remains a banking crisis, people think it's a bond market problem, as I say, we trade bonds. It's not really a bond problem so much as a banking crisis. And we could see banks basically requiring enormous amounts of liquidity to basically stay afloat. Now, probably can't see this particularly very well, but what this highlights is the ongoing need for banks in certain countries for lender of last resort facilities. Basically, central banks providing liquidity once normally a bank has given it some asset, which it has eligible collateral. Now, basically, as this crisis in the Eurozone has been going on, more banks in more countries have required financing. The banking sector in Greece is on life support. They're rolling over 30% of their balance sheet through the central bank system, 30%. And 100 billion of that, by the way, is emergency liquidity with no eligible collateral behind it because the Greek banks have run out of eligible assets to take through. In the case of Ireland, it's about 20% of the balance sheet. In the case of Spain, the figure was going up through the roof. In the case of Spain, they were rolling over before Draghi made some verbal intervention. They were rolling over 12.5% of their balance sheet. So this, what I've got here is a chart showing the amount of liquidity needs of the Spanish banks alongside the 10-year Spanish government bond yield. And you can see how this need for liquidity by Spanish banks was going up through the roof and basically went above 400 billion euros. Without this, the Spanish banking sector would die. And then without that, the Spanish economy would go obviously into a much worse position, which then could spread through the system and knock out other banks in other countries. And this is the real concern which the ECB has been addressing. So at the end of last year, they introduced these these lending facilities, giving banks financing for 3 years. 3 years. And they thought, that's it, we solved that problem. Basically, though, what we saw was that any non-peripheral investors in France and Germany, sold down all their peripheral holdings, and the banks in those countries, in Spain and Italy, just acquired more of their own paper, which made them more exposed to a sell-off in the bond market. And you can see what was happening to Spanish bond yields. Spanish bond yields were going up very sharply to basically above 7%. Now, in this point, the Spanish banks were in real danger because they'd basically eaten more of their own cooking, they had more of their own government bonds on their balance sheet, and those government bonds were falling in price as the bond market was melting down. So at that point, Draghi had to intervene. Moreover, when he actually spoke in London in July, the market, in our view, had never been so bearish, so negative on peripheral paper, Spain and Italy. And we were seeing people actively selling it through the flow. So he spoke and the market turned. But the point is, we're still not in a good equilibrium. We still have the Spanish banks requiring ongoing support. We have a system in recession. So what's going to happen next? Now, everyone was assuming that Spain would go to a bailout, and when Draghi basically said, if and when they go to a bailout, I will buy the paper in size, unlimited, they would go to a bailout. But no government wants to admit they have a problem. Politically, it would be disastrous. So they're holding off, and as bond yields come down, the Spanish government has been able to finance itself. So it's carried on a little bit longer than people were thinking. But basically, I think what will happen is the ECB will have to basically go and do quantitative easing. And in the same way that we've had here in the UK, and we've also had in the US and Japan. We now have a system in recession. We have a system that's still in a bad equilibrium. He's managed to avert this risk in the market's mind of EB breaking up, but he hasn't pushed the system into a good equilibrium. We have some of the banks in many countries on life support. We have recessionary conditions. We have an inflation rate that's going to fall very significantly. In macro terms, he needs to do more, and I think he will do more. They'll cut the policy rate at some point, either December, or they'll wait until the first quarter, and then basically we'll move, I think, to quantitative easing. What will that mean? It will mean that they're buying all bonds. So the Bundesbank, which is the German central bank, will end up buying Bunds, its own paper. Banque de France will end up buying French oats, and so forth. I think also we'll get the creation of what is called a Eurobill at some point early next year. A Eurobill is a short-dated paper of less than 1 year duration, and that will come with a very high credit rating. For the markets, this will be a very important step, because the markets will see that as a precursor to the creation of a Eurobond. Now, in my own mind, I know there is problems inside Germany, for example, of creating Eurobond, because it's an admittance. This is a transfer union, which is effectively where they're going anyway. But they don't wish to accept this, and obviously we have elections in Germany next year, so it's going to be very difficult to sell this to the German public before then. So a bill is an alternative to a bond, but it would be seen as a very positive move by the ECB. The final thing from me is this chart here, because my time is up. This shows part of the issue. We still have these substantial imbalances inside the system. Germany is still running a sustained large current account surplus, as is the Netherlands, and effectively this is the nub of the problem. And this problem is going to be addressed, but it's going to take a long time. So I'll leave it there. I think the system is in a bad equilibrium, it's in recession, the ECB will have to do more, but this is a very slow process, as we always knew it would be. And eventually we will get, I think, to a full political union, which is what should have happened at the outset. But I'll leave it there.